Welcome to the Successfully Retired podcast with Hamilton Brandenburg.
All right, Hamilton. Today is one that I think gets lost a lot in planning. We're planning for retirement. The spouses are planning for retirement. They're excited. They're talking about the trips they want to take and all that sort of stuff. But there's a darker side to it, which is what happens when one of those spouses passes away early,
Mm,
right?
yeah.
And so I think today let's just cover the things that people need to know, how it actually happens, um, the things you can plan for, and really what that process looks like when and if it happens.
No, that's a great idea. I think, to your point, like nobody thinks that's going to happen to them. But I mean, how
Yeah.
many times does that happen to somebody we knew personally or a client? I've had clients this year personally, multiple clients who, within the first 5 years of their retirement, they lose a spouse. And so
Yeah.
it's not something we like to talk about a lot when we're starting to do retirement planning, but always in like the back of my mind, I am trying to crunch numbers to make sure that this scenario works just
Yeah.
as well if it's only one person doing it as it does if we have both of them, because there's some things that are different. What do you think are some of the first big things that you look for to say, hey, we want to make sure we cover this base in case a
Yeah.
spouse
Well,
passes away early in retirement?
I mean, the obvious one is just income, right?
Yeah.
How much income and cash flow is going to change, and the first one is Social Security is going to change, and we're going to talk about just briefly how that actually happens, so the people listening know and can
Sure.
really just do the mental math in their head. And this is becoming less uh, of an issue, but how much of that income is derived from a pension?
Yeah.
Uh, we do have some. I mean, still, teachers, state employees are still coming out with pensions, but uh, those two things are going to affect the surviving spouse's income, and
Mm,
depending on the numbers, it could be quite a bit.
yeah.
So the very first thing that I do is I literally in my plan kill off each spouse independently early, and then look at that cash flow plan beyond and just test it to see, can you make it if that happened tomorrow? And if
Mm,
not, how do we adjust for it? And that could be adjusting future spending, that could be implementing some life insurance, that sort of stuff. But usually, it's just going to be looking at the income. And so to put a bullet on that, why don't you just tell people how Social Security works? Is pretty simple, but I'm finding that a lot of people don't actually understand how that works and when your spouse dies.
No, that's a great question, Rick. There's the simple way to think about it is that when one spouse concludes their retirement, then you're going to get basically the larger of the two benefits. So you're not, so if you had, husband's making 2,500 a month Social Security, wife's making 2,000, husband passes away early, then she's going to get a one-time widow's benefit, like $250
Yeah.
from Social Security Administration, and then she's going to get the difference between her benefit and his.
Yeah.
So it's kind of important because you need to know that if you're, if a lot of your spending for just like your what I've heard people call your minimum dignity floor, or just like the bare amount that you need to cover food and medicine and clothing and your housing and all that stuff. If you're counting on two Social Securities, and it doesn't really work without two, then you might have a problem if
That's
you
right.
go down to just one, because you might get the larger of the two. Yeah, you'll get that, but you're not going to get both of them stacked together. So
Yeah. And
that can
so
create a pinch.
you stack on a pension,
Yeah,
depending on, and a lot of people are coming trying to make the pension decision. They didn't make it already. So there's
sure.
two ways to go about that. How do we make the decision? Or I already made the decision. Show me what happens. Like it's
Yeah,
too late. Show me what happens if I die tomorrow. But when you're making, if you haven't made the pension decision yet, you do have some options. One would be take a higher amount for your life only and hope that you live a long time. There's the other kind of standard ones would be take a little bit less, and if you die early, your spouse continues to get 50% of that. And there's all different kind of percentage combinations in between, but those are the two most popular. What about taxes? It's something that gets missed a lot as well. The tax change
yeah.
from going joint to single. Let's talk about how that could affect someone's plan in retirement.
That's a good point, yeah, because I mean, you think about it, let's say, most people kinda get that, hey, if you have married filing jointly, your standard deductions double, a lot of your thresholds are higher for things like your Medicare IRMA,
Yeah.
numbers and stuff like that. So, there's a lot of things that are very beneficial for 2 people, especially if you're pretty frugal and you're not spending overly lavishly. But if your spending is kind of at a baseline with you and your spouse and you're like, "Hey, if we go down to one person, we're not cutting our spending in half, right? Maybe we're cutting our spending by 20 or 30% because
Yeah.
we still got to pay property taxes, things like that. So that happens. And all of a sudden, your standard deductions cut in half.
Yeah.
Your Medicare IRMA is reduced. So that threshold's reduced. So you have a chance of potentially paying the higher Medicare Part B premiums.
Yeah.
You're in a situation where, unless you have a really weird situation, then your tax filing status is gonna change, at least the year after your spouse passes away. There's an exception to this if you have, like, minor children who are living at home, but that usually does not apply to people who are retired. Occasionally, but not often.
Yeah, I think that's super important and often gets missed because if you're doing it right, you should have a few things in place going into retirement, and especially in
Yep.
the first couple of years. An income plan and a tax plan, and those two things should work together.
Yeah.
Okay. So what you're saying is when a spouse passes away, the income plan doesn't dramatically change.
Yeah.
Right? So now if part of my income plan is drawing 40 or 50 or, it doesn't matter what the number is. Let's say $50,000 a year out of my
Sure.
portfolio and 90% of that portfolio is taxable. The only thing that really changed is now I don't have as favorable of a tax status on that $50,000 because
Yeah.
my deduction is lower, my IRMA is higher, all that sort of stuff. Maybe you had a 10-year Roth conversion plan, all this stuff that was around taxes, and now your thresholds have dramatically dropped and you need to revisit and rebuild that tax plan based on the new numbers, or else you're going to have some big surprises in the first couple of years.
Something that you just said reminded me of a meeting I had. And so when I just got through kind of my spring surge meetings, and one of our clients, you talk about spending doesn't go down when it's just one
Yeah.
person. Sometimes people are actually planning for spending to go up. And I've had this with multiple clients, but I had a couple recently who, as we're talking together, the wife says, "Hey, listen, if he passes away first, I need to pull out 3, 4, 500,000 to go buy a house to be closer to some of my adult children."
Yeah.
So this is a situation where, like most families, 95% of their money is in pre-tax
Yeah.
401k IRA money. So we're looking at, hey, that $400,000 house could cost you six, seven, $800,000 depending on your
Yeah.
situation. So we're building in a plan where, guess what? We have a 10-year term life insurance policy.
Yeah.
We have some taxable money that was not invested that we're putting to work now. And
Yeah.
we're doing $20,000 $30,000 Roth conversions every year over the next 10 to 15 years,
Yeah.
so that by year 14 or 15, we have enough money inflation adjusted so that if husband passes away, wife can go cut a check for that second house
Yeah.
without having to pull it all out of her IRA
Yeah.
and messing up her Social Security taxability, messing up her Medicare Part B premiums, and messing up her tax plan completely. But
And that just
a lot of people don't have the foresight to think about that 10,
no,
15 years
that
early, and they
just
get
goes
screwed.
back. Yeah, that goes back to the very beginning where we're just say, add this to your plan.
Yeah.
Like literally mock out what happens if husband dies tomorrow. What happens if wife dies tomorrow? It'll help you make some decisions today
Mm.
to financially be set up for that, because then once that happens, if you didn't have a strategy, you didn't have a plan for it, there's a lot of scrambling going on. So we've done plenty of episodes on estate planning and beneficiaries and all that sort of stuff, so we're not going to beat that up, but just go quickly on one of the other things that does happen, and talk a little bit about registration of accounts and beneficiaries, and hopefully avoiding probate and things like that when
Yeah.
there's still a surviving spouse.
Every state's different, but
Yeah.
typically, you have a spouse pass away. Any assets that they have that don't have a beneficiary or a transfer on death or a payable on death or that are not in a trust, those assets are going to go through probate typically. I had a call with a lawyer recently, and she was telling me about a situation with a couple where the husband passed away. He didn't have a will, and in their situation, there was a surviving wife, and 3 minor children, and the judge, the probate judge in the state where she practices, determined that the house went to surviving wife and 3 minor children in equal shares, which just made a really huge snafu when they went to go sell the house and buy another house. It's like,
Yeah.
well, now my 3 kids own more of the house than I do. Now, I
Yeah.
know this is a show about retired people, but the point is, if you haven't done planning and anticipated this happening, you could be in a situation where money that you need, especially, hey, old 401k with no beneficiary, I'm going to need that
Yep.
for whatever. It's got to go through probate, or you have a very difficult time getting your hands on those funds and just bringing a traumatic situation to resolution. That's how I'll say
Yeah.
that.
And really for things like the house and the vehicles that aren't jointly owned. By the way, you can jointly own a vehicle if you don't know that.
Yeah.
It does make things a lot easier. But for things like the house and whatever else, to avoid, long lost cousins coming out of the woodwork, or uh, a messy, maybe one of your kids is going through a divorce, and
Yeah.
now all of a sudden there's assets up for grabs. Like, things can happen. Having just literally a will, the first sentence in that will is very simple. All after expenses, all assets go to my surviving spouse,
Sure.
Alicia Lucchini. That sentence covers a lot of problems for people. But what we're saying, to even avoid having to access that, update your beneficiaries on all your accounts,
Yeah.
make accounts joint when you can, put transfer on deaths on them. More and more accounts are able to do that, like even just simple banking accounts and things like that. Get it all set up so that you can avoid probate and make things as easy for their surviving spouse as possible. And I think
And if
that's
you're
really
listening to
where.
this, make
No,
sure
go
that
ahead.
you redo your will and list Alicia Lucchini as the person who you're leaving
Yeah,
everything to.
yeah, that's all
All
you have to
listeners.
do. Yeah,
All
but
listeners.
but
That's
but
right.
really, it's quite simple, and it gets messed up. And
Yeah.
just go through all your accounts right now and just say, is my wife or is my husband either jointly own this or the primary beneficiary at
Yeah.
100%? And if
Yeah.
not, change it now. It's super simple. But I think making things easier is where we go next, before we finish this, because we're talking about the technical side, how to actually do it. Um, but there's a lot more to it for that surviving spouse emotionally,
Yeah.
right?
Yeah.
And so y- I don't know that you can plan for that, but
I don't think you can. Yeah. How
no,
how
but
can you
but
how can you
having
envision that?
well, no, but having some of this stuff built out ahead of time, so that instead of trying to make decisions in a terrible time, you're
Yeah.
executing already made decisions. That's important. And two, having a trusted advisor, whether it's your financial advisor. I know you and I do this kind of stuff for our clients. If it's a friend, a lawyer, a son, whatever, someone that's trusted that can come in and organize all this stuff for you and say, sign here, sign here, sign here, versus you trying to grieve and call the bank asking
Yeah.
them why they froze your account when you tried writing checks for it and your bills are bouncing and all this sort of shit that's going on, right? Having someone help you through this process, knows what they're doing and organize it, is super valuable, because the last thing you want to do
Yeah. Let's do
is
it all
have to
yourself.
handle all this yourself when you're trying to keep it together emotionally.
It's stressful. Yeah, you don't wanna add stress to trauma and to pain. It's hard,
Yeah.
and it's good to have a sounding board. Just know who your sounding board is gonna be. Don't be afraid to reach out to a friend who's been through a situation, to a brother,
Yeah.
to a sister, to, your financial advisor, and don't be afraid to ask some stupid questions, because 'cause they're not stupid questions. They
Yeah.
just feel overwhelming because 'cause you're in the thick of them. So, no, I think
Yeah.
that's great.
I think that's a good place to leave it.
One more thing before you go, you should know that this podcast reflects the personal opinions and viewpoints of myself, your host, and Brandenburg Financial Services. The information that I'm presenting is not a comprehensive analysis of all the topics we're talking about. It's general in nature, and it's not personalized investment advice, so please do not construe it as a recommendation to purchase or sell any particular security or strategy. The views reflected are subject to change at any time without notice, and no representation is made as to the accuracy, completeness, or relevance of the information presented. Guest appearances on this podcast do not represent an endorsement, a level of expertise, recommendation, or any affiliation with Brandenburg Financial Services. This podcast may contain information that could assist you in the development of subsequent discussions with the appropriate professionals and should not be construed as investment, tax, insurance, or legal advice. Therefore, please consult your financial, tax, legal, and insurance professionals regarding your specific situation. Any forecasts or forward-looking statements are based on assumptions, may not materialize, and are subject to revision without notice. Past performance is not indicative of future returns. Investment advisory services offered through CS Planning, an SEC-registered investment advisor doing business as Brandenburg Financial Services.